When building diversified stock portfolios, it's very critical that you focus on the proven risk premiums. Hi, I'm Scott Leonard, certified financial planning professional and founding partner of Navigoe, a wealth management firm. What do we mean by risk premiums? Well, the one that everyone really thinks about is when you're actually buying stocks. You're buying stocks versus, let's say, buying bonds because you expect a higher return. You expect that higher return because you're taking risk and you expect a premium for taking that risk. And that is really the first premium out here, which is the market premium. So we're thinking about owning stocks. We expect the market to do better than owning bonds. And that's that market premium. But in stocks themselves, there's actually three other premiums that exist there. The next one is really a size premium, which just means really large companies tend to be safer than small companies. And since smaller companies are riskier than larger companies, you should have a higher expected return. There should be a risk premium that you should receive for owning small companies versus large companies. Next one is relative price, many times referred to as value companies. Well, that's a function of a price to book ratio, which is really price is their market price, book is what the accountants call it. And so if you have a high price to book ratio, that just means you're a growth company. It means the stock market has valued the company much greater than what the accountants have valued the company at. Why? Because they expect it to grow. The converse of that is a value company, many times when the market might be valuing the company at the same price as what the accountants value it at, or maybe even lower than that. And that's where the term value comes from. If you could actually go out and buy a company with all of its shares and then disband the company and make money, that would be considered a value. Well, what's the market telling us? There's a risk with those companies. They're in some form of distress. And that's why they're riskier than large cap growth companies. And so again, if you're going to own a value company over a large growth or over a growth company, then you should have a higher expected return because you're taking a risk premium that's there. The last one is profitability. And what is the profitability saying? It's just basically saying that high profitability companies tend to have a higher return than low profitability companies. Now, kind of counterintuitive on the risk premium that we've been using around some of that. You would think a very profitable company may be less risky than a low profitability company. But for whatever reason that's there, and there are some explanations behind that that are beyond the scope of today, that high profitability companies tend to have a better, higher return than low profitability companies. And those are really the core equity risk premiums that we're looking at. How would that come about if you're actually building a portfolio? Well, first of all, if you're going to say, okay, we're going to go into the market, we're going to own stocks over bonds, we want that market premium. And let's say these are all the stocks, all these little dots that are making up the companies that were set premium. Now, as we go here, right, as the colors get darker, we're a higher expected return that's going to happen. So then we come into company size and we take large and small. As we own the small cap companies, risk premium, we expect higher expected returns for owning small companies. And this micro cap here is even a little bit higher. Then we can go in and say, now let's look at relative price, the value premium is often called too. So value versus growth companies, we have a higher expected return. We have the small companies here. And look, there's actually a stacking effect that as we own the small value companies, we're actually even getting a higher expected return. And then lastly, we add in the profitability, and the profitability is kind of spread out throughout the whole marketplace. So you can see there's been some of these light blues that have been added even into this large cap growth area, right? And that's just because these are highly profitable large cap growth companies. And interesting, there's even a place down here in the small cap where we lose some of the expected returns for having these low profitable large cap growth companies. So what might some of the numbers look like if we pull all this together? Well, first of all, when we talk about the market, it's about a 10% return is what you're going to get in the market. That's not the premium. That's what the long-term average kind of return has been of the total US market. Now let's just talk about that large cap versus small cap. So large cap part of that market has basically had a 9.98% return, right? Let's just call that 10. So when you go large versus the total market, you actually aren't losing much with this kind of a large mix of stocks that are there. But when you go small, that number becomes 12.7%, which is kind of the small cap premium, the return we expect from getting that. Now let's look at value versus growth. Over here, growth about 9.5%. So when you go more growthy than the market, which would be safer than the overall market, you're losing a little bit of return. But again, not really much, it's all. But when you come back down to the value side, you're at 12.66% when you're owning those value companies, right? And then if you stack this, and if you own the actual small and value companies, that small value, you're at a 14.5%. So that's the historical returns of these different asset classes when you're focusing on the real risk premiums that are out there in the marketplace. So where's some of the data that really sits behind that? And so this is the size, the value and profitability premium, different time periods. These time periods are when they actually have the full data for each one of for all these different market factors that are there. And what you can really see, and this is one of the things that shows this is a true risk premium, is it's not just in the US, but you see it across all equity markets, US, non-US, developed markets, and emerging markets. You're seeing this premium, small versus large, small beating large, small beating large, value beating growth, value beating growth, value beating growth, and so on. And that's pretty important with all of this. And lastly, I think the important piece here, we're looking at US markets, is these premiums are not consistent year in and year out. And they can't be, right? If you knew that every single year your stocks are going to do better than bonds, then where's the risk? There has to be a risk there in order for there to really be a premium. And if we look at, average 1-year periods, you're going to say about 70% of the time you expect stocks to beat bonds. And if we go look at 10-year periods, we're at about 86% of the time. And that's an important one. Everyone kind of thinks about that, but they think 10 years, I'm going to be fine. But no, not always. Large cap, you can see the numbers here, kind of any 1 to 5 year period, it's about a 50-50 chance whether small is going to beat large. And when you get up here to the 10 to 15 year period, about 75% of the time, small beats large. Value, same, similar types of numbers, and you can see the profitability that's there too. Now, again, this needs to be consistent across all markets. Developed non-US markets, you see similar trends. And across emerging markets, you see similar trends. All of that data leads to suggest that these are true risk premiums. And these are the risk premiums that you need to focus on when you're building a diversified equity portfolio to try to get you a higher expected return than just the US large cap growth market.